You ever see a headline where some huge company tells Wall Street it made billions of dollars, but then you hear they told the IRS a completely different story? It sounds kind of shady, right? Like a magic trick? But here's the thing. It's not. It's totally legal, and it's all about telling two different tales for two very different audiences. Today, we're going to pull back that curtain and see exactly how they do it.
So, yeah, how is this possible? That's the big puzzle we're going to solve together today. And I promise you, this isn't some expose on cheating or finding loopholes. It's about understanding that there are two different rule books for the exact same game. If you stick with me, you'll be able to see the real story that's happening behind the numbers.
All right, here's how we're going to break it all down. First, we'll talk about why companies even keep two sets of books. Then we'll get into the nitty-gritty of timing differences. That's what makes the numbers diverge. After that, we'll see how accountants actually bridge that gap. And then we'll look at a totally different example with bonds that follows the same logic. Finally, we'll tie it all together. Let's do it.
Okay, so let's jump right into this core idea. A company isn't being sneaky when it does this. In fact, it's actually required to tell different stories to its two most important audiences, investors on one side and the taxman on the other. You can think of it like speaking two different languages, where each one has its own grammar and its own set of rules. And this right here, this is the fundamental difference. For investors, companies have to follow rules we call GAAP. That stands for Generally Accepted Accounting Principles. The whole goal of GAAP is to show a company's true economic health over the long haul. But for the IRS, well, the tax code has a much simpler goal. How much tax do you owe us right now, this year? These two very different goals are the reason the profit numbers can end up looking miles apart. So how exactly do these two stories start to drift apart? Well, it almost always comes down to one single thing: timing. See, the differences between the investor books and the tax books are either temporary or they're permanent. We're going to focus on the temporary ones, because that's where the really interesting accounting puzzle is. A temporary difference is pretty much just what it sounds like. It's not a question of if a company will count an expense or some income, it's all about when they count it. In the long run, the total amount is exactly the same, but in any single year, the numbers can look really different. Eventually, though, it all evens out. It all comes out in the wash. Let's look at some real-world examples to make this concrete. Depreciation is a classic. For tax purposes, a company might want to write off a new machine super fast to get a bigger tax break today. Makes sense, right? But for investors, they'll use a slower, more even method to show smoother, more stable earnings. In the end, the total depreciation is the same. It's just on a different timeline. The same logic applies to stuff like estimating future warranty claims or potential bad loans. And just for contrast, you've also got permanent differences. Now, these are the easy ones. They never reverse. A great example is interest from a municipal bond. That's real income to the company, so of course it shows up for investors. But the tax code just says, nope, that's not taxable. End of story. These don't create that accounting puzzle that we're trying to solve. So, if these timing differences create this big gap between the investor story and the tax story, how in the world do accountants bridge it? Well, they use this really clever tool called deferred taxes. Let's break down exactly how it works.
Okay, so let's imagine a pretty common scenario. Let's say your company used that aggressive depreciation for your taxes. That means your taxable income is lower than the profit you showed to investors. So you get to pay less tax today, which is awesome, but you know the IRS is going to get that money from you eventually. So on the books that you show investors, you have to record that future obligation. It's called a Deferred Tax Liability. It's basically an IOU to the taxman.
And you guessed it, this works in reverse too. What if you've reported an expense to investors, but the tax code says you can't actually deduct it until, say, next year? Well, that means your taxable income is higher today, so you're effectively prepaying your taxes. That prepayment is a future benefit, right? And it gets recorded on your books as a Deferred Tax Asset, or DTA. So here's where it all comes together. The tax expense you see on an income statement isn't just one number. It's actually made of two parts. First, you've got the current tax. That's the actual check you're writing to the IRS. In this case, that's $400,000. Then you have to account for the change in all those future IOUs and prepayments. Here, that adds another $2,000. So the total tax expense that investors see is $402,000. The story for investors reflects a future cost, not just the cash that went out the door today. Now, this whole idea of timing, the cash you pay today versus the long-term economic reality, it doesn't just apply to taxes, not at all. It shows up in a lot of other places too. And a perfect example is how companies account for the bonds they issue. Okay, so when a company issues a bond, it promises to pay a certain interest rate, right? We call that the stated rate. But the market, at that exact moment, has its own interest rate.
So, if the company's bond pays more than the market rate, investors are going to pay extra for it. That's called a premium. And if it pays less than the market, investors are only going to buy it if they get it at a discount. And right there, that creates another gap between the cash paid and the true economic expense of the bond.
So how do accountants close that gap between the cash the company got up front and the bond's actual face value? They use a process called amortization. And the goal is really simple. Just slowly adjust the bond's value on the books year after year so that on the day it finally matures, its book value is exactly what it's supposed to be.
Let's look at a premium bond. The company pays out a check for $80,000 in cash interest. But look over at the interest expense column, the number it actually shows to investors is only about $65,000. So what gives? Why the difference? Well, it's because the company is using that extra cash it got from the premium to offset the expense over time. The cash story, 80 grand out the door, is totally different from the economic story of a $65,000 expense.
And for a discount bond, it's a perfect mirror image. The company is still paying $80,000 in cash, but because it got less money up front when it sold the bond, its true economic interest expense is actually much higher, over $92,000 in year one. That extra, non-cash expense gets added to the bond's value, slowly building it up to its full face value over time. Once again, what you see in cash doesn't tell the whole story.
So we've walked through deferred taxes and we've walked through bond amortization. And at first glance, they might seem like totally different topics, but they are both rooted in the exact same principle. Let's bring it all home.
And that brings us to the big takeaway, the thing to remember from all this. Whether we're talking about taxes or bonds, we're talking about the same core idea. Financial reporting isn't just about counting the cash that came in and out the door this year. It's about recognizing the future consequences of today's events, all to paint a much truer, more honest picture of a company's performance over the long run.
So I'll leave you with this question to think about. The next time you look at a company's financial report, just ask yourself, what story is this really telling me? Is it the cash story of today, or is it the economic story of tomorrow? Understanding that difference, well, that's the key to seeing what's really going on inside a business. Thanks for joining me on The Explainer.